Welcome to another episode of the talkin.TAX podcast with your host, Omar Aswat. And with me today is Kevin Whelan from Wealth Builders, specialist in SSAS pension funds. Kevin has an enormous background when it comes to looking after business owners and property landlords, and has specialized in the small self-administered schemes for over 2 decades now. We'll be asking Kevin many questions in terms of for myself personally, and I've asked a couple of my contacts to present their questions as well, so that we can benefit from Kevin's presence and knowledge and expertise in this 1 hour session. Without further ado, let's introduce Kevin. How are you doing, Kevin?
I'm great, Omar, and lovely to be appearing on your podcast, because I know you've been on mine, and I know we share a complete passion and obsession almost to help people, particularly the business owners and property business owners, to save tax, to realize how they can make more money, make more profit, and of course, as we'll discuss later today, how to preserve that money and protect it from the most hated tax in the country, which is inheritance tax, and big changes coming down the track that you and I both know, but perhaps it'd be good to share some of those during our call today.
Exactly. Pleasure to have you on, Kevin. And it was an honor to be on your podcast just over a month ago. We spoke about, as you mentioned, the inheritance tax changes coming into play from April 2026. And for the viewers, stay tuned. Why? Because there are other tax changes from April 2027 that you'd need to be very wary about. And yeah, I think the main thing is awareness, right, Kevin?
Awareness is everything. I think I call it clarity, because when you're clear on the rules, when you're clear on the actual principles, rather than, oh, I've heard this or I've heard that, when you get clarity, you can then make a decision. And you can always make one of three decisions. I'm clear on the rules, and I'm happy that what I'm doing is perfectly suited to these rules. There's nothing I need to do. There's something I can do, and I can do it myself, and I can tweak what I'm already doing, or I need some help. And usually, if you need help, it's because the amount of saving that you can make is massive. And both you and I know that when we get involved to help people, the savings we make dwarf any cost. So it's not about trying to get money. It's not trying to offer a service. It's really trying to say, when people don't really understand what they are doing in this very specific area, whether it's SSAS, whether it's inheritance tax, whether it's a whole bunch of different tax issues, then of course they can catch a cold, they can step on a landmine, and pay the price, often to the tune of tens of thousands when it comes to inheritance tax, simply because of the size of people's estates these days, and the fact that the tax net is getting bigger and bigger and bigger as the government sort of keeps the allowances frozen. They've been frozen since 2009, and they're going to be frozen till 2030. So we've just got more and more people swimming into the net and catching a very, very significant tax bill, or at least their beneficiaries do. And we want to try and do everything we can to help them avoid it.
Excellent. It's very interesting what you've just mentioned, Kevin, which is you can do one of either three things. Gain the clarity, which is, do nothing, everything is fine, change something, or get the expert advice and transform your position effectively, right? From a seriously negative situation to something seriously beneficial and positive for the family as a whole. If we take a step back, Kevin, we just want to understand a bit more about Wealth Builders and what exactly, how long have you guys been operating for? I think it's many years, right?
Well,
and
I'd check out the wizened expression here, Omar. So I've been around the world of finance for 35 years now. Starting off as an economist when I was young, then into mortgage broking, then into IFA work, then into SSAS work, and latterly into being a specialist for business owners, property business owners, and older people to minimize inheritance tax, mainly because I think it's a tax that people just simply are not aware of. And as I said earlier on, they drift into it. Whereas with other taxes like corporation tax, they're touching it every year. Their income tax, they're doing their self-assessment every year. So there's a regularity and a frequency, a cadence to touching the tax. Inheritance tax never gets touched. It just happens when somebody dies. And I want to do as much as I can to help people understand that. Not that I'm dwelling on death, but as the son of a business owner who died, unfortunately, in his late 40s, you know, I saw what happens when business owners are unprepared, when they don't have a will, they don't have a power of attorney, they don't have their life cover sorted, they don't have a business succession plan. And the other one they fall into is they don't realize what's going to happen to their business when finally they're no longer here. And, you know, you touched on that on the podcast with BPR, with the business protection, and the fact that so many business owners think that when they pass their business on to their kids and their kids can inherit it all 100% tax-free. Well, you and I know that's not the case. And anybody who wants to know more about that can listen to the podcast with you on Wealth Talk. So check out Wealth Talk and you'll hear your incredible lessons there. And I'd like to focus today a bit on the dreaded inheritance tax, because particularly around the world of pensions, because I think just as inheritance tax gets left behind, pensions get left behind. It's almost like people don't have a great relationship with the concept of pension, yet everybody's got one. I mean, in the UK, it's the mainstay of people's retirement planning. And whether it's a workplace pension, whether it's a personal pension, whether it's a SIP, or as we'll discover for many people, new language of SSAS, or the small self-administered scheme. And I'll touch on why the language is very clunky. It's because it's very old. You know, it's created in 1973. You know, there wasn't even a mobile phone. Internet didn't even exist. And I had hair. You know, that's how long ago it was. So, yeah, so definitely be good to focus on some of these things. But my background has always been to obsess around creating multiple streams of recurring income, to become completely financially independent, and to leave an incredible legacy. And that's what I pass on. And I will just touch on and raise it so that it fuels a question for you. Almost everybody I meet in the world of finance, and this takes a brain shift, it's a paradigm shift, focuses on value. In other words, how much is in my pension? How much is in my ISA? How much is in my bank account? People focus on value. And inheritance tax is a tax on value. Inheritance tax is not a tax on income. So if you can create multiple streams of recurring income, as I'll share with you, you can give away as much as you like. There is no inheritance tax limit. There is no 7-year rule or a 7-year clock, as sometimes people call it. It's absolutely enormously powerful to get to a place where you've got multiple streams of recurring income, creating financial certainty in your life, from business, from property, from investments, from pensions, from joint ventures, from intellectual property, from a whole host of different sources. And the more you build that up and focus on recurring income instead of value, the more you create certainty for you, less inheritance tax for the next generation, and greater certainty and involvement for them, which is fundamental if we're going to teach the next generation how to become stewards of money, not spenders of money, custodians of money, not consumers of it. And that's important to me, to be able to share lessons, not just transfer money, but transfer wisdom alongside it. So hopefully you're getting that I'm very passionate about this, and it takes a paradigm shift for every business owner and every property owner to think about that. Property owners less so, because they're already focused on income streams from property, but business owners are almost always thinking about the value of their business as opposed to the recurring income that it could generate.
Wow. Very, very, very insightful, Kevin. I think from a lot of the reading that I do, wealth and mindset go directly hand in hand, right? it's all about the mindset when it comes to creating wealth and also preserving wealth. Mindset is extremely important, is what I've learned from my recent readings. So it's interesting that you touched upon that angle. And you also mentioned around income versus value.
Yeah.
Yeah. As a tax advisor, the immediate item that came to mind was, when it comes to inheritance tax, was gifts out of excess income. Is that what you were alluding to, or was it something else?
I'm alluding to that because I think most people don't realize that inheritance tax is a tax on capital. It's not a tax on income.
Sure.
So in order for someone to understand what inheritance tax is, it's a tax on death paid by the living without any event that leads to a revenue stream to pay the tax.
Wow. Beautifully put. I think that will be clipped out into a 10-second short.
Yeah, I mean, that's a dry tax if
Amazing.
there was one, right? And it comes at a time when people are less equipped to deal with it. We're living longer, so more likely people have had periods of illness or loss of mental capacity. And the next generation are ill-equipped to be able to understand. And we've had a long period, the great wealth transfer, as we call it, the tsunami of money flowing from baby boomers like me, who've worked hard to build money, but didn't really spend time teaching the next generation anything. And the school system didn't teach them, and the work system didn't teach it, and the university system didn't teach it. So as a result, nobody's teaching them anything. So I think the important thing to try and understand, not just where you are now, but also if you've got elderly parents who perhaps are that silent generation, not talking, is to really understand where inheritance tax comes from. And given the black hole in the government economy right now, we're spending 100 billion a year just in interest payments, and we've got a 50 billion black hole. And I think we've heard from the Chancellor that they're probably going to break their manifesto pledges in the budget upcoming. I don't know when this will go out, but as we speak now, it's early November. And so they've got to find money from everywhere. So they've got to look everywhere. And obviously inheritance tax is getting, the take on that is getting bigger and bigger and bigger every quarter. And the biggest change that's coming is, again, people talk to me and think, oh, I haven't heard of that. Or if they have heard of it, they think, is that a consultation? Is that a proposal? No, it's not. It's the tax on pensions. So in other words, till now, if you died and you left whatever was in your pension pot, and we're talking specifically about people who've got money in pension pots, sometimes called money purchase pensions, sometimes called defined contribution. In other words, it's money you can see on a statement. It's money you can see online. It's money that represents value. Hence, if you see a value, you see inheritance tax. So from April 2027, anybody who dies, their pension is going to form part of their estate. And that's going to shunt the value of their estate because, you know, I've got north of 7 figures in my pension. I didn't expect this to happen. I didn't plan for that to happen. I've responded to government incentives to be responsible for my own pension when they changed the rules in 2015 to say, you can manage your own pension, you can manage your own longevity, keep your money in your pot and work out how much you want to keep, how much you want to spend, manage your legacy. They then removed the lifetime allowance, which you recall was just around $1 million. That's all gone, hinting that you can build your pension up to whatever value you want. And now they're saying, we changed our mind. We think pension just for retirement only, and we're going to tax everything that's left behind on your death. And for some people, that's just going to take their estate that they thought was their property and their investments or their business, and it's going to shift that up dramatically without any knowledge and any amount of method by how the next generation are going to be able to work that out. Because the other thing that's come up, not just the tragedy of that, but the responsibility for the assessment of that, the calculation of that, the coordination of that, and the payment of the tax falls on executors.
Wow. Okay, Kevin.
Lay people who don't have any knowledge of pensions law are all of a sudden going to have to find all the lost pensions that are out there, try and find every pension somebody's got. And I've already said people don't have a great relationship with their pension, evidenced by the fact that there's 27 billion or 30 billion now probably of money that's just floating around, pensions unclaimed, that all of a sudden the executor, who's now got to take a complete legal responsibility for this, if they get it wrong and underpay the tax, the legal obligation to meet it, and therefore fines, penalties, and so on, will fall on lay executors. And there's a huge call now from some of the ex-ministers, Baroness Altman, Steve Webb, ex-pensions ministers, saying this is so unworkable at a time when people are in grief, who haven't been taught a thing, now all of a sudden have got a legal responsibility to get it right and pay the tax all within 6 months. It's just not going to be possible.
Wow. Okay. Yeah. It's not looking good at all, Kevin. I really want to unpack. I really want to unpack this for our viewers. An initial question that I have is: you mentioned 2015, and maybe before my time, before I got into this field, into the tax field, just over a decade ago, but someone was mentioning that pensions were always part of inheritance tax, and then some while back, they removed it from inheritance tax and simply bringing it back in now.
No.
Is that not true?
That's not true.
Okay.
No.
Fine.
Up until around 2015, there was an obligation when you had a pension to turn that pension into some form of annuity. You had to give the pension value to an insurance company, and they would give you an income in exchange. And with annuity rates falling dramatically, I mean, what an annuity is really an upside down life insurance policy. If you think about it, if you have a life insurance policy, if your listeners thinking, I've got a life insurance policy, what am I doing? Yeah. Well, I'm paying a small premium to get a lump sum. An annuity, that is the upside down version of that. You pay a large lump sum to get a small premium. So you pay, say, 100,000 in to get an income fixed for your lifetime, right? So you get a small premium back. Now, when I started in 1990, the annuity rate was 15%, Omar.
15%.
15%. So if you had 100 grand, you get 15 grand a year. If you've got $1 million, you got 150 grand a year. Now you'd be lucky to get, when around the earlier years, and certainly in recent years, we've seen interest rates at 0% and annuity rates with 3-4%. So wow. if you've got £1 million, and you're going to get 40 grand a year as opposed to 150 grand a year, it's just not workable. So I think the issue for me is when the government made the change, and there are some pensions that have always been excluded from inheritance tax, and I'll touch on that in a moment. But when they brought in the change called pension freedoms in 2015, they said, this is an unfair system. It's unfair because you're having to give away your money at an interest rate that isn't going to give you a good enough income to support yourself. We're going to give you the right to control your own pension, to control your own pot, and then almost like a reservoir. You build your own pot or a bucket, however simple you want to, and then you turn on the tap to draw whatever income. Now, if you give someone that responsibility, clearly nobody knows when they're going to die. Thank goodness, but nobody does. So they've got to balance how much money's in their bucket with how long they might live. So because it's not predictable, you have to have a buffer. You have to have money left over to be able to manage that process. And now what they're saying is whatever's left in that process, in that bucket when you die, is going to be subject to inheritance tax. And I understand the argument. I just don't think it's been thought through in terms of giving people enough time. If they've taken 15, 20 years to build something up, and then all of a sudden you can't do that anymore. So look, we have to face the reality that we now have to deal with it, right? So that's fine. So dealing with it means being more aware of the rules first. And then secondly, what are the things you could do yourself? Thirdly, what are the things you could do with help? So, and this is where, you know, my focus on that has helped me understand how some pensions are better than others in this regard.
Okay, excellent. Thank you very much for the extensive background explanations, and you touched upon life insurance, annuities, all very interesting. I'm pretty sure for the listeners. In terms of, I really want to jump into the potential tax planning opportunities. However, I just want to take a quick step back again. I think a good question is, what is the difference between a SIP and a SAS?
Okay, well, I'm going to answer a different question first, if you don't mind. I'm gonna ask you to imagine we're flipping a coin. Up we go, heads or tails, right? If we land on heads, we're landing on pensions, which are only going to provide an income. They're never going to provide a value. They're just going to provide an income. They're not affected by that. Okay, so
an example.
State pension.
Okay, yep.
Okay, if you work for the government and you're a civil servant, if you work in the armed forces, my son-in-law's a firefighter, if you've got a final salary pension with the government, or a final salary pension with a big company, because mostly they're all closed now to new members, then your pension value is always provided to you as an income. So you reach retirement date, you get a pension income. And that income, if you die, is not subject to inheritance tax. Because it's an income, right? That's heads. Tails is all money purchase pensions, money in a pot pensions, personal pensions, workplace pensions, SIPs. A SIP is a personal pension with a slight degree of flexibility. So a lot of people get confused between SIP and SAS because the word self comes in, right? So let's just deal with the tails. Personal pensions, nest pensions, workplace pensions, SIP pensions, money purchase pensions where you don't control the investment. You're a beneficiary of a trust fund. A pension is a trust fund, and there are always trustees. Trustees manage the money on behalf of beneficiaries. That's what a trust is. So if you're in a workplace pension, somebody's managing the money on your behalf. You are the beneficiary of that money, okay? So because it's building a value, all of that money is going to be subject to inheritance tax. On second death, there's no tax to pay between husband and wife, by the way, right? Important not to scare people to think they die, their pension's going to be taxed. Well, would be if you're single. If you've got a spouse or a civil partner, and you leave that money in the trust by filling out a form, then that money will pass to them without inheritance tax, but it will be taxed on the second death. Okay, stay with me. Go on.
Yeah, I just wanted to ask, is it a necessity to fill out a form to say it's going to the spouse?
It's not a necessity because they have what's known as discretionary powers, but it's better if you do, because if you do, you make your wishes clear. And I'm always a fan of clear wishes, not opaque wishes. If you're clear, you're clear, right? And of course, you could have the law of unintended consequences, right? You could leave a pension to an ex-spouse, and if you don't change it, the ex-spouse is going to get it. So we talked earlier on about how most people are paying attention to income tax, corporation tax, because it's regularly in their life, it's in their field of vision. So whenever you go through a life change, a relationship change your expression of wish or the form that relates to all of your pensions. So
Excellent.
so they're the big landscape of pensions is heads, final salary, tails, money purchase. But you'd recognize, if I use the £1 coin analogy, the coin could land on its edge, couldn't it?
And
It could.
it could, yeah, it could.
Theoretically, right? So, but there are three edges anyway: heads, tails, and the edge.
Okay.
The edge is SSAS because it's an edge. SSAS is a pension scheme for business owners. It just happens to have a clunky name. Small self-administered scheme. Right. Let's debunk the language. Small means a small company. So the people that you serve, the people that I serve, not Tesco's, not BA, not massive companies, small companies, SMEs. So if a small business owner says, okay, I'm small and I want to make my own decisions about my own money, that's small self-directed, but the name came up in 1973. So it didn't get called small self-directed pension. It got called self-administered pension. It's not about administration, it's about direction. So just as a limited company has directors, a SSAS has trustees, but you become the trustee. So you're not giving the trustee responsibility to another company. You're not giving the trustee responsibility to an employer, except you. You as the employer of yourself. You see what I mean? So the small self-administered scheme is another word for pension. That's all it is. It's a trust fund where instead of having somebody else managing the decision-making, like a director manages a company, you manage the decisions in your pension. So you can decide what you want to invest in. So if you want to invest in your company, you can. You want to invest in property, you can. You want to invest in crypto, you can. If you want to invest in gold, you can. So you invest in what you choose to invest. So it's a money purchase pension, but with you in the driving seat, not in the passenger seat or in the back seat, you're driving it. There's still bookkeeping, there's still compliance, but that's done as an administration service paid for by you to somebody else. No percentage fees at all, but the small means up to 11 people. Okay, so you can have 11 people in a scheme. Why that becomes relevant is huge. Because in every other pension, it's a pension for one. How big is a personal pension? One. How big is a SIP? One. How big is a final salary scheme? One. SSAS up to 11, which means, just by a quirk of law, if you can pool your resources, you've now got a multi-member scheme. And if you've got a multi-member scheme, you can make decisions on behalf of the members in the scheme, which means you can bring a spouse in, you can bring business partners in, you could have siblings in, and you can have grown-up children in when they're 18. Now, once you understand that, it now means that the trust that you set up as a SSAS is your bespoke trust. It's yours. It doesn't belong to Aviva, Legal and General, or anybody. It belongs to you. It lasts 125 years. Most pensions are going to pay out within 2. So that's the law. So now you've got a pension that doesn't stop. It carries on and your children can run it. So let's take a simple example. A husband and wife, 3 grown-up kids. Happens to be my scenario. Okay. So what can I do in that I can't do in a SIP? That will start to answer some of your questions about the difference between SIP and SSAS. So how many people can I have in a SIP? One. How many people can I have in a SSAS? Up to 11. Who's the trustee of a SIP? Somebody else. Who's the trustee and the decision maker in a SSAS? Me and my family. I've got five of us. Now, if I decide that I want to build my pension up, but I've got more money than I need, and I want to cascade some of the money in my name over the long term to my next generation, I can do that. That's called earmarking. It's a principle. It's called earmarking. You cannot earmark in a SIP. You cannot earmark in a personal pension because by definition, it's for one person. So how can you earmark it for somebody else when there's only one person in it? But with the SAS, you can cascade money. That's benefit number one.
Okay.
That's a big difference between SIP and SAS, is you can do that.
That is. Just a quick question there, sorry. When we say earmarking, are we talking about preparing legal documents to earmark the funds, or are we talking about changing the trust deed to earmark the, as in how would that work in practice?
Well, I'll give you a simple example because every family is different. But if you had let's do it very simple. If you had a husband and wife team, the husband was super risk tolerant and the wife was super risk averse. I'm sure there are some families that your listeners have like that. You could have the investments like crypto in the name of one person and the property in the name of another person. So you can shift the balance of assets between different people. It just gets more sophisticated when you're looking at it from an inheritance tax angle. But that's a huge benefit. The second thing to mention is that one of the unique features of SAS is you're allowed to lend up to 50% of the value of the pooled resources to your limited. It's called a loanback, SAS loanback. Now,
is that specifically to a limited company that you are the director / shareholder of? Any company?
It's to a company to which you're a director shareholder, because the purpose of this pension is to support you as a director of your own limited company. Now, I'll give you two benefits. One that's got nothing to do with inheritance tax, then one benefit's got to do with inheritance tax. Won't be lost on you that there's been a proliferation of people setting up property limited companies since government interventions. And many people who've got money in their pension pot are not really a fan of the stock market. They're not a fan of somebody else managing their money. They're not a fan of paying assets under management fees, a percentage of their pot to financial institutions. So they want to stop that. They want to control things for themselves. But one of the benefits, other than the pooling that I've mentioned already, the choice of investments, which I've mentioned already, but you can lend up to 50% of the value to your own company. So say you put a husband and wife both together, they've got 200,000 each, simple numbers. You can now lend, you've got 400 in the pot, you can now lend 200 back to the limited company. And if the limited company has got the SIC codes, the standard investment classifications or industrial classifications, whatever it's called, that says we're a property company, 68209 or whatever, we own and operate real estate, you can do what that company does. So if that company does residential property, you can buy residential property with that money. So you're lending your own money to your own company to buy residential property that you can't do in a SIP, you can't do in a personal pension, you cannot do in a family salary pension. So you're creating investment flexibility to build your wealth today, as opposed to sending all the money to build your wealth tomorrow. Now, look, I realize this is complex. You and I are both professionals. This is tough to understand. It takes people a month or so to get their head around. It's why we've created resources. We've created books, we've created guides, we've created podcasts, we've created videos. So however people learn, they can get this. But get this point. If you've got all the money you need and you want to reduce the inheritance tax take on your pension, and you heard what I said about lending back to your company, if you lend money to your company and your pension owns a loan note back to yourself and you pay the interest back, the pension's getting paid an interest rate. But the growth of the use of the money could be in a company where your children are shareholders and directors. So you could be creating an asset in their name from your pension today, which means you're reducing the inheritance tax. You see?
Okay.
So you're starting to be able to move money in the way that you choose to, but you have to have the paradigm shift. Because if you don't realize and get clarity on it, you think all pensions are the same. You don't even believe this is possible. And it's not that it's new, it's fancy, it's unchallenged. This is standard stuff being going since the 70s that has been tried and tested hundreds and hundreds and hundreds of times. And it's not an issue that HMRC have a problem with if you follow the rules.
Okay. Excellent. Excellent, Kevin. Much appreciated. For the listeners, definitely visit Wealth Builders. You'll find them on social media, on the website, and LinkedIn. You're pretty active on as well, right?
Yeah, but what I'll do, if you want me to, I'll create a sort of a goodie bag for you. So if anybody wants to go to wealthbuilders.co.uk/ASWATAX.
Oh wow. Okay. Let's do it.
I'll create for you a resource pack based on what we uncover today in
That's
our
excellent.
conversation. So SAS resources. I'll send a book, video, and a guide. Book, video, and a podcast.
Yep.
And I've just written an inheritance tax guide to minimize your inheritance tax on your pension. I've just literally finished it. It'll be out next week or so, and I'll give a free copy to everybody who clicks on that link. So wealthbuilders.co.uk/ASWATAX. So as long as you put a link in the show notes, Omar,
I will do.
then there'll be no problem with getting that. Did
For
you
sure.
want
And
to
I'll
ask a question about the loan back?
Yes, I did. So it's amazing what some of the things you've mentioned, which is it's crazy how the awareness is still not there in terms of how powerful a SAS pension can be for business owners. In terms of the lending, so I did, just before you mentioned about lending 50% to a company that does residential property, for example, I asked you the question, which is, does it have to be a company that's under, does it have to be the sponsoring employer, or can it be to another company? So I just wanted the clarity around that, please.
Okay, well, let me give you the clarity. In order for a loan back to work, a loan has to be made to a company attached to the SAS. For a SAS to be approved, there has to be a sponsoring employer, use the terms, which means a company where there's clear evidence you're a director and an employee in the company. However, you can add additional companies. You add them just like adding a network cable to a computer. You want to add another one, you attach it. And as long as you've got the network set up properly, you can link it to another company.
Okay, excellent. That's really, I think that's really important for the viewers to know. Okay, so we're talking about investing and earmarking the activities and the investments. Can we now talk specifically about the changes, the potential planning opportunities that business owners should consider to begin with, and then to reach out to the experts for potential advice, please?
Well, I think, given the challenges of inheritance tax are going to be faced by many, I think the big one is probably the executors going to be faced with this challenge. I think the best thing to do for clarity anyway is to do a stock take on the pensions you've got. You know, find out what you've got, do an old sort of CV and look at who you used to work for, and try and get visibility of your pensions. And then where possible, think about the consolidation of that into a single vehicle to create simplicity, to create visibility, to focus on returns and focus on cost reduction. Because here's another paradigm shift, Omar. You and I spend a lot of time talking about tax, but we don't often articulate tax. as being a recurring income that leaves your life. So if you're paying corporation tax, you're paying that corporation tax every year, and it's leaving your life and you can't get it back. If you're paying income tax, it leaves your life and you can't get it back. Obviously, if you make contributions into a pension, you get it back. And I'll come on to that for children in a minute. But if you think about the other big thing that leaves people's lives, which reduces the value of their wealth, is ongoing fees. And most people are not paying attention to those fees. And it's a tax. And it's not untypical for people to be paying 2% of the value of their fund and not paying attention to it if it's a patchwork quilt of pensions with pension over here, pension over there, pension over there, pension over there. They're not paying attention to anything, let alone the fees. Now, if you think about fees as a percentage, and let's say it was 2%, because that's the average, and you've got that 400 grand that I mentioned in that sort of fictitious husband and wife, that means if they weren't paying attention, 8 grand a year will be going in fees, which means you don't get it back. It can't compound. And the insurance company or the industry gets paid before you get paid. They're not taking any risk to get paid. And even if the money goes down, they get paid.
Okay.
I'm not sure that's always a good deal. I don't have a problem with paying fees as long as you're getting value for money. But in some cases, you're not. And with the advent of AI, with the advent of technology, you can manage money now for 0.2%. You can buy fund management for 0.2, yet people are paying 2. Omar, 10 times more than they should. 10 times more. And that's because most pensions are sold for a profit. They're not arranged to give the maximum value to the beneficiary. The benefit is mostly and increasingly claimed by an industry which may or may not be adding value. So I'm not going to criticize an entire industry. I'm saying get visibility and clarity on your fees. Find out. And the consolidation thinking doesn't mean consolidate. You need to take advice if you need to take advice. Sometimes it's quite simple. You can do it on your own. Just look at the fees, look at the simplicity of the pensions, make sure there's no guarantee, no protection, no benefit. And if you're not sure, get advice. Pay somebody to tell you and give you the clarity. Probably would cost you £500 or £1,000 to get that clarity. But either way, consolidate. If you think about consolidation, you're making things simple and you're making things easy for the next generation or the executor to deal with that. That'd be the first thing I'd say to do. Second is look at the SSAS. If you've got a limited company, look into it. Don't do it. It's not for everyone, but look into it. When you get the visibility and the clarity of what it does, and you ask your own questions and you see, you listen, watch, or read, and then you ask more questions, then you talk to people who've done it, you start to get a feeling for whether it might be right for you. And if it is right for you, then it's a consolidation exercise, because SSAS, you've got all the money now coming from all the various places, not just from you, but from a spouse or a business partner or siblings, and you put it all together. Now, I did mention contributions and corporation tax. Many business owners don't like corporation tax. I think you and I would agree on that. But they pay it nonetheless. They don't want to pay all the dividend tax, do they? So they leave money in the company and they pay their corporation tax. And you and I would be saying to them from time to time, but you know, you could pay money into your pension. They go, pension, schmension. I'm not really bothered about pension. Yeah, it's too far in the future.
Down the line.
Okay, fine. But if you think about this paradigm shift, don't pay the corporation tax now, put it into a tax-free trust fund, build it tax-free for the future, bearing in mind there's no inheritance tax till second death. And in any event, you can lend 50% to yourself to build your wealth. You could lend it to your company, so you can get the corporation tax back and even lend it to your company to grow your company. You don't have to buy property with it. I just gave an example of that. or you could use it to build pension contributions in the names of your grown-up children. So provided you've got a legitimate company with legitimate children doing, I don't mean legitimate children, but legitimate work for your company, then you can pay pension contributions into their name. So you're building wealth in their name, but taking the money out of the company now and paying less tax now to give them a tax-free legacy for the future. So there's an awful lot of good preparation and planning that can be done by understanding that SSAS is a family wealth plan, not a single person plan.
Sure. Excellent, Kevin. Thank you very much. When we make contributions, or when contributions are made into a SSAS pension fund, as you've mentioned, there's the immediate corporation tax savings at potentially 25%, right? Because usually we're talking about the slightly larger businesses where they might be paying 25%, but even 19% is an immediate tax saving, and it's up to £60,000 per individual. So as you mentioned, if we look at the husband and wife, 3 children case, technically they can make a contribution per annum of £300,000, saving tax at 25%, which is around £75,000.
It's a huge sum of money.
It's huge. But one of the potential pushbacks that I've heard many a time, it's not a pushback, it's just a scenario that I've encountered where you present the solution. So you have a £75,000 immediate tax saving, and then they'll immediately, it's very short-sighted thinking, I appreciate, but they'll immediately start thinking, okay, how can we now get the money back in our hands? And you have to sort of explain to them.
The 50% loan back is the way to do that, which you can't do in a SIP, you can only do in a SSAS. But also you could still use the money to do other things with. So I've already mentioned the breadth of investment choice, but for example, let's say you're into property, let's use that as an example, and you want to, or you've got a business, you could use that money to buy your business premises. So instead of paying a landlord, a third-party landlord, you pay yourself. So now you're paying yourself, the rent you pay to yourself is tax deductible, so it comes off your corporation tax. Then the pension money grows completely tax-free, and then you've separated an asset from your company, so you're not putting your company in jeopardy of not getting BPR, right? Because you're not having the company asset, which is property, linked to the company trading value. So there's all sorts of value there. You could have somebody who buys a commercial property and then splits the title to create a commercial to residential conversion. So the commercial property is kept in the pension, and the residential parts can be passed to the company. So there's just so many different ways. What it always demands is this is not something you do on your own. You know, when I said, when you get clarity, you can say, I'm happy. I can do it myself, or I can get help. With SSAS, you need to get help. And of course, you know, putting myself forward as somebody who's a capable, competent person to help people understand whether it would be a good fit. But that's all I do, is help people understand. Would it work for you? Would it work well? Will you save corporation tax? Will you save inheritance tax? Will you build wealth in the way that you want to build it? And bearing in mind, you know, the typical cost to create a SSAS is about £3,000, because you've got some legal work to do to create a trust fund for 125 years. Amortize that over 125 years is a tiny sum of money. But it costs typically between £1,200 to £1,500 a year to run. Well, they were paying £8,000 before in fees. You know, now they're not paying those fees anymore, because they're taking responsibility for their own money. And as the fund gets bigger, the fees don't get bigger, because it's fixed fees based on administration time, not fees based on percentages of money. So often when I do a cost benefit analysis for someone and they've got a decent sized pension pot, this becomes a financial no-brainer, an IHT no-brainer, a corporation tax no-brainer, and a family no-brainer. Because again, I'm trying to draw the threads of this together. We touched on some benefits of SSAS already. One, earmarking. Well, let's make them simple. One, the SaaS is a consolidation tool because it puts your money from different places into one. Simplifies your. Two, you're collaborating, you're bringing more people in, which means you've got more money, which means you've got more buying power, which means you've got more leverage. Three, you can earmark. Cascading. Four, you can add your grown-up children. Five, you can make contributions. And by the way, a lot of accountants don't know this, so forgive me if you may not. But with certain companies, because the revenue allows you to create something called a general unallocated fund, you're future funding your pension, you can pay up to £500,000 in 1 year and get the corporation tax relief in 1 year. So
Sure.
for more successful companies, they can even put in £500,000, take 25% of £500,000, right? You got 125 grand. That immediately reduces your corporation tax bill. Now, I'm not saying everybody listening is going to have a business that can pay £500,000, and you don't even have to pay 60, but you can make contributions depending on how much corporation tax you're paying. That will start to help you build your wealth, build your legacy, but build a relationship with children, because as children are grown, grow up, and they're living longer, and nobody's teaching them anything. One of the things I love about doing SSAS is by inviting them in to become trustees, not necessarily bang on when they're 18, but to get them involved. It means they're starting to transfer wisdom. We're starting to transfer knowledge. We're starting to have children act as AI champions or Dragon's Den participants in a family trust fund that says, hey, Omar, what if we were to allocate £100,000 of the family's trust fund to you? Go and research and come back and tell me what you would do with that money that would help the wealth of the family grow. So you're starting that involvement. Can you imagine having a conversation like that with your workplace pension or with your personal pension? It's never going to happen. So for all of these reasons, the consolidation, the earmarking, the pooling, the contributions and the involvement, the reduction in fees, there's such an overpowering reason, in my mind anyway, for people to find out more, not to do. I'm not saying everybody should do, but to find out. And then when you get the clarity, you can say, well, I found out more. I'm happy with the pension I've got. Okay.
Yeah.
It's absolutely fine. And we'll spend time with people, a couple of hours we'll spend with people, an hour up front and an hour once they've had the information. So we'll give them 2 hours of our time completely free of charge, but to help them make that assessment, not to push them, not to cajole them, but to say, hey, in your situation, would this work? And would it work absolutely clearly for you? Yes or no? And then they make their own mind up what they want to do. So I would encourage everybody to look further into it. If you've got a pension and a family and a limited company, those three things, you'd be very well advised to take some time, take the 4 hours, or 2 hours rather, take that time and investigate. And if you don't like me, investigate with somebody else. I'm okay with that, because inheritance tax is such a big issue for me. I want as many people as possible to not pay that tax. And you know what, Omar, with the right plan and with bearing in mind tax is paid on second death, not on first death. There's a quote that I keep in mind, and I may not create it verbatim for you, but Roy Jenkins, who is an ex-chancellor, said, inheritance tax is a voluntary levy. In other words, you don't have to pay it if you don't make a plan. A voluntary levy rather, paid by those people who distrust their heirs more than they dislike the HMRC or the taxman. And it's a joke, but it goes to the point that if you have a good plan and you create a good plan, you can probably avoid IHT altogether, which circles us back to gifting out of income. Because it's always more difficult to gift from capital because you don't know what capital you're going to need, because you've got an uncertain life, because you've just got value, you've got no predictable income. And the maximum gifts you can make, subject, there's some small ones at $3 a year, which are teeny tiny, but for a couple, that's $6,000. Well, do that over 20 years, 120 grand. All right. But you've still got 325,000 you can give inheritance tax free. But gifting capital is always a tough gig because you lose control. Whereas if you've got a very solid, dependable streams of recurring income coming from a multitude of different assets, and I've written a book called The 7 Pillars of Wealth, the 7 and only 7 assets you can use to build recurring income. I could add that to the goodie bag if you want, so people can get that.
Amazing.
Don't overwhelm people with knowledge, because people who are overwhelmed do nothing. An object at rest stays at rest because they get overwhelmed. So I might not do that, but you could check the website out. Anyway, you get a high level of recurring income, and say you've done a great job and you need 10 grand a month to live, and you've got a really solid 10 grand a month, but your income coming in from your assets is 20 grand a month. You can give that other money away and there's no inheritance tax on it at all. There's no 7-year immediate tax relief, and there's no 7-year rule. There's no check on the calculation. Yes, you've got to document it well, and we know how to document that well, and we can show people this is what you need to do. These are the 6 or 7 steps you need to do to document it. But once you've done that because you never know when it's going to be needed, on death you have to prove it. Well, if you've kept the records for 20 years and kept the records in a proper way, in a safe or a digital vault, either way, and that's for another day, you can keep that record so it's absolutely clear that you're gifting. So you can gift from capital and from income. You can do both. So I think with a good plan, almost anybody can avoid inheritance tax altogether. And that for many people is tens of thousands, hundreds of thousands, or in some cases millions. And I think I would encourage anybody to tot up the value of their estate. Have a little look. Just say, add up everything you own, take off everything you owe, see what the number is, approximately. Doesn't have to be accurate. If it's more than $1 million, get in touch. If it's more than 2 million, you're in trouble, because you're going to lose one of the allowances that, the residence nil rate band, leaving your home to your family, you're going to lose that, which means, for bigger estates, higher value estates, people with properties, people with businesses worth multiple millions, they're going to lose so much inheritance tax that they could get back if they could plan it.
That's exactly one of the key issues around the pensions coming into charge from 27, which is that you might have a modest couple, they own their main residence, they don't have no rental properties, they don't have a business, they just have the main residence, let's say it's valued at about £750,000, right?
Yeah.
And just a modest couple just living life, and they've built up the pension pot, for good reason. And today there'd be no inheritance tax payable because it's under the $1 million, but the pension pot now between the two of them is, let's just say, 1.5 million. You've gone over the 2 million, and now you're even losing the residence nil rate band. So it's like you're just getting attacked from all angles.
Yeah, and people are not aware of it. So because they're not adding the pension to their estate, they're not adding it. So I would now, if you're listening to this, add your pension in. The other thing people forget to add in, by the way, is they forget to add in their life insurance.
Insurance policy, yeah.
They got life cover. They think it's just insurance policy. But if they don't put it in trust, they die, the money forms part of their estate, and it could be subject to inheritance tax. And it's the simplest document in the world to take a life insurance policy, fill a form in, a bit like people with final salary pensions, they fill a form in, say, if anything happens to me, I leave my pension to my spouse or whoever. You do the same thing with your life insurance policy, and then it's no longer subject to inheritance tax. It doesn't cost anything, zero cost. It just means you have to know it exists and get it from the insurance company, and they will give you the form. You fill out the form, free of inheritance tax.
The form, is that right? Is that form writing into trust, or what's that form doing exactly?
The form, what the form is doing is saying, if you've got a life insurance policy, let's take an example. Say someone's got a life insurance policy for £250,000 to protect their family or to pay a mortgage off or whatever. And it's just a policy. Then in order for that policy to pay out, probate has to be granted. Which means in order to get probate, you've got to pay your inheritance tax. Because you can't get probate, which is being able to deal with the estate, until you pay the taxman. Taxman's paid first. So the life insurance policy, if you don't specify, will go into your estate, which means you could pay inheritance tax on it. And also you're going to have a delay because the insurance company can't pay your spouse, say it's to your spouse, because probate hasn't been granted, because the tax hasn't been paid. Well, if you fill out a form that says, do not pay this into my estate, pay this directly to my spouse, it doesn't form part of your estate and it doesn't have to get probate.
Okay, which is, it's amazing benefit just with that one form, but the problem
One
is
form, no cost.
no cost. But the problem is there's just no awareness. Now, if we begin to conclude our session, are you okay for time?
Yeah,
Kevin?
I'm good. I'm good. I'm enjoying it.
You're good. Okay.
Hope it's not too heavy, because I'm feeling we've unpacked a lot, Omar.
We definitely have. And whilst I've made a lot of notes here, which is that I think we definitely need a round two at some point with going deep into certain aspects, which is such as the general unallocated fund I want to go into. You mentioned there's a particular way to the gifts out of ordinary income. You said there's a way to document the life insurance. We can go into. So I think these are all for another session where we can really unpack. But yeah, definitely, it's been very, very interesting and definitely insightful for the audience. What do you think is the reason for such unawareness about such powerful tools, such as the SSAS pension fund?
That's a great question. I mean, I suppose it comes down to the fact there's no natural place where this information is shared. Because if you think about, where do people get their information from? And if we've said earlier on, they don't get it from school, they don't get it from university, they don't get it from the workplace. So where do they get it from? Well, they get it from interrupting their life. And who interrupts their life? Everybody's busy. Everybody tells me they're busy. Oh, I haven't got any bandwidth. This is too complicated, blah, blah, blah. So they tend to, the reason why most people are not wealthy, frankly, is the amount of time they spend in a year and then in a month to look into these things. Like, think about it. How much time does everybody spend on their pension in a month? In a month, no time. In a year, I get my statement, I read it. Thought I wished I were better than it was, and I put it back in the drawer. I mean, obviously I don't. I've got a SAS, but most people spend zero time. Now, let's think about this. I don't want to be too down on the industry, but how do most people get their pension? They get it because it's sold. And who's got the greatest level of interest for inertia to be left where it is? Because the funds under management is, leave your money with me, we'll take care of it. You'll just set it and forget it, leave it till you're older. That's what most people do. Sure. So those people who become truly wealthy, truly a pioneer of their family's legacy, are those people who take an active interest. And that tends to be people who've been woken up by somebody like you. They've talked to someone who's thinking forward looking, not backwards looking, not the compliance work necessarily or the bookkeeping work, but the planning work, which means you need a relationship. And people don't have relationships like this. Now, obviously, people build relationships with you. they build relationships with me, but there's not enough of them in the context of society. It's not everybody. What I'm hoping, really, despite all the challenges that I think will flow from this inheritance tax issue, is it might be the catalyst to kickstart people to start paying attention.
Sure.
Because everybody's
100%.
got one, you know, and the law requires an employer to pay in. They need to pay in. So it's going to be on their radar. And I'm hoping that enough people will start to pay attention, because it's not, you don't have to learn everything. You just have to start with, how much have I got? Where is it? How much am I paying in fees? Should I consolidate? If I've got a limited company, should I look at SaaS? You know, you just start with one decision. And my experience is, Omar, that when I ask people to do something, and me and my team, it's not just me, of course, we ask people to do things that will take no more than 1 hour, right? So we're not asking them to get bombarded. We're saying, look, you can find your pensions. Here's a way to do it. Take 1 hour, find your pensions, right? Here's a guide on SaaS. It'll take you half an hour. Read it twice. That way you missed the first time because you were still in old thinking, right? Read it twice. That'll take you an hour. Come on a call. It will take you an hour. Okay?
Yeah.
Nothing more than an hour. That way we're trying to break this overwhelming situation that people go, oh, this is too complicated. I'll just stick with what I've got, and don't really understand the price they will pay. And maybe they won't even pay it. It'll be the next generation who'll pay it. And that's okay. You know, not everybody's going to take action. Not everybody's going to follow up on some of these things you and I have talked about, but hopefully enough people will. And when people do find out about these things and they realize the game-changing nature of this, they tell others. So from our perspective, you know, we've got a community now, 5,000 strong. People either doing SaaSes, looking into SaaSes, have got experience of for years of having their SaaS. And it's not just about SaaS, but that's a big thing for business owners. But I think the inheritance tax will be something for people to pay attention to now from April 27. And I'm going to be banging loudly to say, please, please don't just leave your pensions out there, because the very worst you can do is ignore them. And then somebody's got to clean up that mess. And do you really want a mess for the next generation? Not really. Not really. Anyway, it's been fun to share with you. And I'll create the goodie bag for you.
I think that'll be extremely appreciated and beneficial. Just a quick last one, if that's okay, Kevin.
Yeah.
I think it's what you said right at the start, which is business owners, property landlords, they're used to paying income tax every year, and they're used to paying corporation tax every year. Why? Because they have, it's like you just said now, which is someone comes and disrupts your life, which is HMRC come knocking at your door. And that's the only reason they therefore plan for income tax and corporation tax.
Yeah.
But inheritance tax will only be knocked on your door once, and you won't even be around, right?
Yeah, exactly.
So that's why it's this whole mind. I think it's all about mindset. One thing I've definitely taken away from this is the deeper aspect, which is your mindset. If you don't have the mindset in its right place, then there's not much anyone can really do to help, right?
Yeah, I agree with you. I think it's a very valid point, and thanks for kind of re-emphasizing the point I made at the start.
Much appreciated. I think we could probably go on for another hour very easily.
That's not too much, yeah.
Yeah, it'd be too much for the audience. But I think we should post budget perhaps. Let's see what happens in the budget. It's not looking too positive for business owners and for capital wealth. But we'll just wait and see towards the end of the month. And then perhaps we can liaise on another podcast episode towards the end of the year, early next year. Talk about something different.
Happy to do that, and the guide's already written for the pensions and inheritance tax shake-up. That's already written. Sure. That'll be out soon, so your audience will get it. And if you ever want to do a a kind of pensions and inheritance tax Zoom meeting or a webinar meeting where people can ask questions live, because
Yep.
everybody's going to have a question. What happens if this? What happens if that? What happens if I don't have children? What happens if I'm single? What happens if I've got a disabled child? What happens if I've got a mix of both one pension and another pension? How's that going to be affected? So there's all sorts of questions that people will have, and it's always better to answer those questions live.
Nice. Yeah,
So
yeah.
I'd be happy to do that with you if you think that would be beneficial.
I think it certainly would be beneficial. We'd need to just organize the logistics. But as you say, every circumstance is different with tax planning, with pension planning, estate planning. Never one size fits all. So as you've constantly mentioned as well, which is, I think the viewers should really take away from you the fact that not once you've pressured someone or tried to sell them a SSAS, you've always mentioned if it's good for you. And this is the difference between the annual 2% fees that they're paying, which is something they've sort of been sold, versus what you guys are trying to do at Wealth Builders, which is very important in this day and age and much appreciated from, I'm pretty sure would be appreciated from the audience.
Okay, well, thank you for saying so.
Excellent. Any final words, Kevin, before we wrap up?
No, just that watch out, be afraid, be very afraid when it comes to the budget, because it's not going to be pleasant at all. They've already lined us up to expect it. So the country's in a bad way. The state pension is going to be pushed back and back and back. The inheritance tax take is going to go up and up and up. You've got to put some time in your life to look at these things regularly. And I think, to your point, maybe it's just once a year with somebody you trust, whether it's people trusting you, people trusting me, doing an annual webinar, doing something that gives a cadence to people to sort of almost wake up and have a realization of what's changed and changing around them, so they can react, as opposed to letting life just drift over them. And most people just do that. It just
passive living, just living passively.
Yeah. All right.
Yeah. Perfect, Kevin. Pleasure having you on. We'll share all your details in the description down below and all the other platforms. But much appreciated. Honestly, very, very insightful and definitely beneficial for the audience, I know for sure. And we'll definitely catch up again soon.
Thank you very much, Omar. You have a good time now. See you soon.
You take care. Cheers. Take care. Bye.